Hi, we're going to learn about debits and credits. So we're going to record transactions and we're going to use debits and credits to do that. Let's see how. One way that we can see debits and credits is by looking in a T account. So a T account is just a way to depict an account. So you can see the letter T on the screen here, and to the left of the T we'll have debits, to the right of the T we'll have credits. So that part will never change. Debit means left, credit means right. So the name of this T account is cash, and we're going to list the debits on the left and the credits on the right. When we add up our debits, we can say 100,000 plus 3,000 and get 103,000. That's called footing in accounting. We just added it up. We can see our total debits are 103,000. We add up our credits. Our total credits are 71,600. To get to what is the balance of cash here, we will subtract debits and credits and then put it on the side that's the biggest. So subtract 103,000 minus 71,600, we get 31,400, and we put it on the side that's the biggest. Well, 103,000 is on the debit side, 71,600 is on the credit side, so the biggest side is the debit side. So we would say that cash has a debit balance of 31,400 on this screen. So we're going to take that and keep learning about how we decided if it was a debit or a credit. And I'll give you a little hint. It's going to be which one increases and which one decreases, and we'll talk about that. To put our transactions into the accounting equation, we already learned that everything has to affect at least two places, and this is known as double entry accounting. So we're going to relate that to debits and credits, and we will also have to have at least one debit and at least one credit in order to stay in balance. Are the rules of double entry accounting. So you already know the accounting equation is assets equal liabilities plus owner's equity. So what we're going to do now is show you how you can use this accounting equation to figure out if a debit increases that account or decreases that account. All right, let's look at this. So which account is to the left of the equal sign? Here's your equal sign right here. Which type of account is to the left of it? Assets, right? So what we can tell you now is that everything to the left of the equals is going to increase on its left side. Okay, so what do we mean by that? Well, here's your asset, and the left side is always a debit. So because assets is on the left-hand side of the equal sign, assets increase on the left. So an asset increases with a debit. So if an asset increases with a debit, then that means that it automatically must decrease with a credit. All right, let's keep going. So what is on the right of the equal sign? Liabilities. So because liability is on the right side of the equal sign, and this rule will always apply to liabilities, then it increases on its right side, which its right side is always the credit side. So liabilities increase with a credit. The opposite would be that they decrease with a debit. So far what we've learned is that assets increase with a debit, liabilities increase with a credit. Owner's equity will work the same way as a liability because it's also on the right. So owner's equity will increase on the right, so it'll increase with a credit, but it will decrease with a debit. All right, well that's great, but as you know, we have more than just these three accounts. We've got all those components of owner's equity. So let's expand this and see how the rules will apply to those. That's what we have here. We still have our accounting equation, assets equals liabilities plus equity, but now we've expanded our equity into our four components. Now, capital, which are owner investments, have a positive impact on owner's equity. They make it increase. Withdrawals have an inverse relationship. It makes it decrease. Revenues have a positive impact and expenses have a negative. So if it has a positive relationship to owner's equity, it's just going to work just like equity does. It'll increase on the right. Everything will increase with the credit. So let's find that. Here's owner's capital. It has a positive relationship, and again, it increases with a credit. Here's revenue. It increases with a credit. But what about those with an inverse relationship? Well, let's look at withdrawals. It has an inverse relationship to owner's equity, so it's going to work the opposite. It's going to increase on a debit, just like assets do, right? And then expenses have an inverse relationship to owner's equity, so again, it will increase with a debit. So let's see how we're going to use these rules. I'm going to introduce a new term to you. If I told you that an asset increases with a debit, a new term for that is its normal balance is a debit. Normal balance simply means which is its increased side. So assets, withdrawals, and expenses increase with a debit, so their normal balance is a debit. And likewise, the other ones, normal balance is a credit. So if you want to increase a liability, its normal balance is a credit. So you will. We think back to the statement of owner's equity that we looked at. It was beginning capital plus owner investments plus net income minus withdrawals. So the way that this works is that we start with our owner's equity and we add in our owner investments and then we add net income. Well, remember, net income is just the net of revenues and expenses. So we would find net income on the income statement and then we subtract out withdrawals. And all of that will flow to the ending equity balance on the balance sheet. Let's take a break from debits and credits and talk about where we are within the accounting cycle. So we've analyzed our business transactions and we are currently in the record the transactions in the general journal. This is where we're going to put in our debits and credits. But when we do that, that's just like a grocery list that hasn't gone to the grocery store. We need to take those transactions and affect our ledger accounts. So that part is when we post it to the ledger. From there, we need to make sure that we did every debit and credit right, and so we're going to prepare a trial balance, and that's going to be to show us if we are in balance. It's going to add up all of our debits, add up all of our credits, and make sure that we equal debits equal our credits. Next, we're going to prepare adjusting journal entries, so if anything didn't get updated, we'll update it then. We talked about supplies a little bit, and that's an adjusting journal entry. And then we will communicate that to our users through financial statements. So we'll prepare financial statements. Finally, we will close the accounts. We'll get all of those temporary accounts down to 0 so that we can start back over and find out how much should go into them for the next period. Anytime you make a journal entry, you need to do a trial balance after that to make sure that we are still in balance, make sure that our debits equal our credits. All right, so let's get back to recording transactions. The detail of our business transaction from a source document, in other words, an invoice, a receipt, a check, or a contract. And then from there, we're going to make our journal entry. This is where we'll write down our name of our account and how much we debit and credited each one for. On July 1, Joan Blue invests $40,000 in cash to form Blue Design Studio. So Joan Blue is the owner, and Joan put personal money into the business. So as we learned when we did this in the accounting equation, the business cash increases and the business equity increases. We want to take this nice and slow. So it's just like when you're learning to play piano and reading music. If you think about it, at first you have to count the lines, figure out what the musical note is on the paper, then look at your fingers, figure out what that note is on the piano, and it takes time, right? It's the same way with accounting. At first we're going to have to think about what is the account? What type of an account is it? Do we want it to go up or down? Do we debit or credit to do that? That's a lot of steps for our brain to do. So I want you to take your time and think through it, because the benefit is if you do, then it quickly becomes second nature. However, if you don't think through it and you just try to memorize them, then it won't become second nature and you'll only know the transactions you memorized and you can't apply it to everything. So with that said, let's take this nice and slow. We said that we want cash to increase. Cash is on the left-hand side of the accounting equation, and so it goes up on the left. So to increase cash, we're going to go up on the left. Equity is on the right-hand side of the equation, and we want that to increase, and so it goes up on the right, so we're going to credit it. That's how we show it in the accounting equation. When we go to journalize it, we're going to put it in the journal, and this is what it's going to look like. So we can see that we used cash, so we're going to write down the word cash. And then we can see that we put it in the left-hand column called debit of $40,000. So we're going to have two columns over here, and we're going to have a debit column on the left, a credit column on the right. So we'll write $40,000 in that debit column. For J Blue, capital, we're going to write that down. We're going to indent it because it's a credit. So we're going to indent it, make it go a little bit towards the right, and then we put it in the credit column. So we're going to put it in the credit column in our journal entry. So this is just a way of thinking about it in the accounting equation. When we actually journalize it, it's written out like this in journal format. Analyze a transaction that's going to end up not being an economic event. On July 1, Joan orders $5,200 of office supplies for Blue Design Studio. So we're not going to make an entry because nothing has happened yet. So we've ordered it, but we haven't gotten the supplies and we haven't paid for it. So nothing is to be recognized. July 3rd, Joan rents an office for Blue Design Studio. She pays $3,200 for 2 months rent in advance. So her cash goes down because she did pay the money. But she can't use an expense yet because she hasn't used the building yet. This is known as a prepayment. So instead, she's going to increase an account called prepaid rent. It's an asset because it'll benefit her in the next 2 months when she does use that office space. So she's going to increase prepaid rent and she's going to decrease cash. So we need to talk about how to do that with our debits and credits. Let's think about cash first. It's easier to think about. We want to decrease cash. Cash is to the left of the equal sign, so it increases on the left. We want to decrease it, so we decrease it on the right. So we're going to credit cash for the $3,200, and that's going to make cash go down. Let's look at prepaid rent. It's an asset because it's something that she paid for, but she hasn't used it up yet. And assets go up on the left, and hers is going up, so we do want to do the left side, so we're going to debit it. Something I haven't told you yet is that when we write it down in our journal, we always put our debit account first. So which account do we debit? Prepaid rent. So we're going to list prepaid rent first. $3,200 goes in the debit column. Then we're going to list our cash, and we're going to put the $3,200 in the credit column for that. 5th, Blue Design Studio receives the office supplies ordered on July 2nd and an invoice for $5,200. Now something has happened. Now we have supplies worth some money. So our supplies increases. But since we got an invoice from it, we can see that we didn't pay it yet, so our cash isn't affected yet. Instead, we're going to promise to pay it. So that's a liability called accounts payable. So our office supplies goes up, and our accounts payable goes up. Now notice you can make two things go up, but one has to be a debit, one has to be a credit. So let's go to the next slide and we'll see how that did in fact happen here. Office supplies needs to increase. Office supplies is an asset. Assets increase on the left, so we need to increase office supplies with a debit on the left. Accounts payable is a liability. We need to increase it. Well, lucky for us, liabilities are on the right side, so they increase on the right side, so we need to increase it with the credit. So even though both of these accounts are going up, one goes up with the debit and liabilities goes up with the credit, so we do in fact stay in balance. So we'll debit office supplies for $5,200 and we'll credit accounts payable for $5,200. Now Joan purchases office equipment totaling $16,320. Joan pays $13,320 in cash and agrees to pay the next month for the rest. So we're going to have 3 accounts affected here, which is fine as long as our total debits equal our total credits. So she got office equipment, so her office equipment for her business increases, and she paid some cash, so her cash goes down when she pays that out. And she also increases her liability account because now she owes some money. So it's like a credit card. Whenever you charge to your credit card balance goes up. So her liability went up. So let's look on the next slide and see how we're going to debit and credit this. Looking at office equipment first. What type of an account is office equipment? It's an asset. Assets go up on the left. Her office equipment increased because she got some new office equipment, so we will debit that. Cash went down. It's an asset. Assets go down with a credit, so we'll credit that. And then accounts payable goes up. Accounts payable is a liability. It goes up with a credit. So we can see that we're still in balance here even though we have 3 accounts. Our total debits equals $16,320. And to get our total credits, we're going to add what we did to cash and what we did to accounts payable because those were both credits. When we add those two numbers together, we also get $16,320. So even though we had 3 accounts, we still stayed in balance. 9th, Blue Design Studio makes a partial payment of $2,600. So whenever you make a partial payment, that means you paid out cash, so cash will go down, for the amount owed for the office supplies that we received on July 5th. So that means we're paying down a liability. So we're going to decrease our accounts payable and decrease our cash. We want to decrease accounts payable. Accounts payable is a liability, so it's on the right-hand side. Right-hand side, things go up with a credit and down with a debit. So I want to decrease it, so I will debit it. Cash also gets decreased. Cash is on the left-hand side of the equal sign. So cash goes up with a debit and down with a credit, so I will credit cash. So I'll debit accounts payable, credit cash for this entry. Finally, making some revenue. On July 10th, Blue Design Studio performs a service for an investment advisor by designing a series of brochures and collects $2,800 fee in cash. All right, so if we performed a service, then that means that we need to make revenue go up. And if we collect money, cash, that means that our cash goes up. All right, so let's talk about how to make revenue go up and cash go up. Cash needs to go up. It's on the left-hand side of the equal sign, so it goes up on the left, so that's a debit. We're going to call this revenue design revenue. That's the account name for the revenue for this company. And revenue is part of owner's equity with a positive impact to owner's equity, so it increases with a credit. So we're going to credit it to make it go up. Same as the last one, except for instead of getting the cash for it, we've already provided the service, but we did it on credit. What that means is that we're going to receive that money later. And so it says on July 15th, Blue Design Studio performs a service, so we did the service, for a department store by designing a TV commercial. The company bills for the $9,600 fee now, but will collect it later. So we haven't gotten the cash, but instead we have the right to the cash called accounts receivable. So accounts receivable will increase and revenue, called design revenue, will increase. Accounts receivable is an asset, and so it goes up on the left. So we'll debit it to make it go up. Accounts receivable will be debited. Design revenue is a positive to owner's equity, so it goes up on the right. So to increase that, we will credit it. Little twist, this time we got paid, but we haven't done the work yet. So this is called revenue that was collected in advance. On July 19th, Blue Design Studio accepted $1,400 in advance, so we got the money, cash goes up, as a deposit on a series of brochures to be designed. We haven't done the work. The revenue recognition concept tells us that we cannot increase revenue until we've done the work. So instead, we're going to put it in a liability account, meaning we owe them the work, and it's going to be called unearned design revenue. Ignore the word revenue when you see unearned design revenue. Unearned is what's important, and that's what tells you it's a liability. It's not a revenue yet until we earn it, so unearned tells you it's a liability. We got the money, so cash increases. As you know by now, cash is an asset and it increases on the left, so we debit it. Unearned design revenue is a liability. We increase liabilities on the right, which is a credit, so we credit unearned design revenue. July 22nd, Blue Design Studio receives $5,000 cash from customers previously billed on July 15th. So we haven't done any new work here. all we've doing here is receiving money that was previously owed. So cash goes up and accounts receivable goes down. So we got the money for something that we had already previously done the work for. So both of those are assets. So we're going to increase cash and decrease accounts receivable. So cash will increase with a debit and accounts receivable will decrease with a credit. So let's just take a minute here and look at this T account. Right now we can tell what our balance and our cash is. All of our debits, which were our increases, minus all of our credits, which were our decreases, would give you your ending cash balance. So we would add up all these, subtract out those, and we'd get our ending cash. Accounts receivable, well, it was $9,600, but then they just paid down $5,000. So now the new balance is the $9,600 minus the $5,000. So we can get a lot of information from looking at our balances and our T accounts. On July 26th, Blue Design Studio pays $4,800 for 4 weeks of employee wages. So in this case, we've got wage expense because our employees have worked and we are paying them. And we've got cash because we're paying them. So let's look and see how to do this. Wage expense is a part of equity, and so that's to the right of the equal sign. But remember, expenses have an inverse relationship to equity. So instead of going up with a credit, they go up with a debit. So wage expense will go up with a debit, and you already know cash is going to go down with a credit. Let's look at an expense that's going to be paid later. This is otherwise known as an accrued expense. So on July 30th, Blue Design Studio receives but does not pay the utility bill that is due next month for $680. So we've already used utility services, so we are going to increase utility expense. But instead of paying it now with cash, we're going to promise to pay it next month. That's accounts payable. So utilities expense goes up, accounts payable also goes up. So again, utilities expense is an expense, so it is on the right side of the equal sign, but it has an inverse relationship to equity. So instead of going up on the right, it goes up on the left. So to increase expense, we debit it. And then we're going to promise to pay it later. So to increase a liability, it's on the right, and it increases on the right, so we're going to increase it with a credit. Owner wanted to take money out of the business for personal use. So on July 31st, Blue Design Studio withdraws $2,800 in cash. When they use that word withdrawal, you know that they were taking money out of the business for personal use. So the business cash goes down and withdrawals goes up because we're just going to keep up with how much that owner withdrew during that period. We need to increase our withdrawals, and so withdrawals is to the right of the equal sign, but it has an inverse relationship. So it's going to go up with a debit, so we'll debit withdrawals, and of course cash goes down with a credit. Summary of all of the transactions. We can see that we have footed each column and then gotten an ending balance. So the ending balance in cash is right here, $22,480 on the debit side. Accounts receivable, $4,600 on the debit side. So what we need to do now is make sure that when we look at all of these accounts together, our total debits equal our total credits. Now again, they're not going to equal in each account. We don't want to have zero balance in cash. We want to have debit balance and increased balance in cash. And we're going to owe some liabilities at the end. So in each individual account, the debits and credits don't equal. But when we summarize all of them together, our debits and credits should equal. We're going to do that test on what's known as a trial balance. Take the previous slide and we write down all of the accounts in a specific order that you can remember through the term ALORE, A-L-O-R-E, ALORE. That stands for assets, liabilities, owner's equity, revenue, and expenses. That's the order of the accounts on the trial balance. So these are all of our assets up here, then our liabilities, then our equity, then our revenues, and then our expenses. And all we're going to do is we're going to write down the balance. If we saw it on the left-hand side, on the debit side before, we're going to put it on the left-hand side here. If we saw it on the credit side on that previous slide, we'll put it here. So we add up all of our debits, add up all of our credits, and our debits equaled $60,080 and our credits equaled $60,080. So we would say that our trial balance is in balance. Our trial balance in balance, we can prepare financial statements. We're going to focus on the balance sheet during this lecture. So you remember that the balance sheet is just a formal presentation of the accounting equation. In other words, it reports assets equal liabilities plus equity. We're just going to break it down a little bit more now. So assets can be broken down into two parts. Current assets, those are assets that will be used up or turned into cash in less than a year. And property, plant, and equipment. That's fixed assets that we're going to hold longer than a year. We can also break down liabilities into two parts. Current liabilities, those are liabilities we're going to pay off within a year. And long-term liabilities, things that are not due for more than a year. Our example of current assets. They're expected to be converted into cash. So take a look. Which ones are going to be converted into cash? Well, cash is already cash. Accounts receivable will be converted into cash when we get the money that people owe us. Same with notes receivable. But the other ones are going to be sold or used up within 1 year or less. So we're going to use up supplies. We're going to use up other prepaid expenses. And if we had inventory, we would expect to sell that within a year. Notes receivable are like an accounts receivable, except for it's a more formal instrument because we actually ask the customer to sign the note. But we're still going to consider, unless they tell you otherwise, that it's a current asset because we're going to assume that they're going to be received within the year. Property, plant, and equipment are also called fixed assets, and they are long-term. They're things that we're going to hold for long-term, and they're going to benefit us for many years. So we'll first put them on our books at their total original cost, and then, depending on what it is, everything except for land, we will depreciate it over a specific amount of time. These fixed assets are physical resources that we own, and they are permanent or have a long life. Examples are land, buildings, and equipment. But as time passes, it loses its ability to provide useful services. That decrease in usefulness is called depreciation. All fixed assets except for land lose their usefulness, and so we depreciate them. So as we do this, we put it into an account called depreciation expense. Type of a journal entry is called an adjusting journal entry because we just do it at the end of the period or the end of the year before financial statements. It's nothing that we do on a daily basis. But at the end of the period, we look and we say, okay, what needs to be depreciated? When we do that, we're going to increase a depreciation expense, and we're not going to decrease the actual asset because we want to show that asset as its original cost. Instead, we're going to use an account that sits right next to the asset and shows that decrease separately. That's called a contra account, and so for an asset, it's called accumulated depreciation. It's called a contra asset because it goes against the asset's value. In other words, it deducts the asset's value. Let's say you've got a building. The building costs $100,000. Let's say you've depreciated it by $10,000. We're not going to reduce the building because we want that building to always show its original cost. We're going to have an account next to it called accumulated depreciation building. And it's going to have the opposite balance in it of $10,000 so that when we look at them together, we can see the net book value of that building. So that's what a contra account does. It reduces the value of the account without having to touch the actual account. Examples of some contra accounts. So land won't have a contra account because we don't depreciate it because it generally goes up in value. Buildings would be accumulated depreciation dash buildings. So let's talk about this. Buildings is an asset, so it has a normal debit balance. Its contra account will have a normal credit balance. All contra accounts have the opposite balance of the account that they are contra to. Store equipment, its contra account would be called accumulated depreciation dash store equipment. Office equipment could have a contra account called accumulated depreciation dash office equipment. Let's make a depreciation adjustment here. We have office equipment that depreciates $50 during December. So we're going to increase depreciation expense and increase accumulated depreciation office equipment. Expense goes up with a debit, accumulated depreciation goes up with a credit. So take a look at this office equipment account. It has a balance of $1,800 on the debit side. And then we've got this accumulated depreciation office equipment with a credit balance of $50. If I want to know my net book value of my office equipment, I would look at its balance minus its contra account balance, and I would say, okay, well, my office equipment is really sitting at $1,750 right now. That's the net book value. So you look at these two accounts together to find that out. And then depreciation expense, of course, would come over here, and expenses decrease owner's equity. Slide shows it to you in equation form. If you want to know the book value of the asset, you look at the cost of the asset, what's in that equipment account, minus the accumulated depreciation of the asset, and that's how you get to the book value of the asset. Going through the balance sheet, and we've already talked about assets, and now let's look at liabilities. So these are amounts we owe to creditors that will be due within a short time, usually 1 year or less, and they're called current liabilities. Notice they all end with payable except for one, which is unearned. Unearned anything is also a liability because we owe them the work. Long-term liabilities are amounts that we owe, but they're not going to be due for more than a year. And again, they're called long-term liabilities. And practice this, we're going to classify these as either current asset, property, plant, and equipment, current liability, long-term liability, or owner's equity section. So Connie Bergeron Capital would be owner's equity section. Notes receivable due in 6 months. Since it's short term, it's going to be a current asset. Notes payable due in 10 years is going to be a long-term liability. Land is property, plant, and equipment. Cash is current asset. Unearned rent, we're going to earn it within 3 months, so that's going to be a current liability. Accumulated depreciation goes right there next to its building or whatever it is, or equipment here, so that's going to be property, plant, and equipment. And accounts payable is a current liability. Just to note that there are other words people use for this. Some people use short-term asset instead of current asset. Some people even use non-current liability for long-term liability. So you just want to watch out for those words. Slide just shows the answers to those questions that we just went over. So thank you for watching, and let me know if you have any questions. Thanks.